In the prior cycle, I estimated they would hit $1 trillion market cap, which it did. Then I was like, I could see it hitting 100,000, and it didn't quite get up to that level. Um, you know, I would be surprised to not see it hit six figures in this cycle.
Lyn Alden begins by highlighting Bitcoin's unique position in the cryptocurrency market. For the past 15 years, Bitcoin has been the largest, most liquid, and most decentralized cryptocurrency. These characteristics give Bitcoin a significant advantage, largely due to its powerful network effects. This means that as more people use and invest in Bitcoin, its value and security continue to grow, making it even more attractive to new users and investors. Alden notes that we are currently in the mid-cycle of a Bitcoin bull market. This assessment is based on various indicators, including the price being well above the lows of the cycle and nearing the highs of the previous cycle. On-chain data also suggests that long-term holders are starting to sell some of their coins to meet new demand from institutional investors, such as those investing through ETFs. Despite some short-term caution due to potential overbought conditions, Alden remains bullish on Bitcoin over the next 2 years. She predicts that Bitcoin will likely continue to rise, potentially reaching six-figure prices during this cycle. This optimism is tempered with a recognition of the inherent volatility and risks, which she manages by carefully sizing her positions.
For 15 years now, Bitcoin's been the largest, most liquid, kind of simplest, most decentralized cryptocurrency. And I think the network effects are very powerful. In the more cyclical sense, I would say that I think most indicators suggest we're roughly mid-cycle in terms of a bull market, meaning that we're pretty high off of the lows that have reached in this cycle. We're around prior highs of the prior cycle. Some of the on-chain indicators are suggesting that there are some longer-term coins coming to market to meet all this new demand from ETFs and elsewhere. And so whenever it gets overbought in kind of the near-term sense, I get kind of cautious. But I do think that Bitcoin likely has higher to run in the next 2 years. And when I look out 10 years, I'm bullish on the asset. So as long as I'm kind of managing that position size relative to its expected volatility or relative to risks or tail risks that I see in that investment thesis, I'm quite bullish on Bitcoin in both the cyclical and the structural sense. In the prior cycle, I estimated they would hit $1 trillion market cap, which it did. Then I was like, I could see it hitting 100,000, and it didn't quite get up to that level. I would be surprised to not see it hit six figures in this cycle. But of course, anything can happen. You're trying to estimate external demand for it. Another thing worth pointing out is that its Bitcoin price is historically very tied to measures of global liquidity. And so, for example, if you look at global broad money supply in dollar terms, Bitcoin's historically been very correlated to that. And that goes up when either the dollar is weakening or there's a lot of credit creation or money printing around the world. And in the past couple of years, that measure's been consolidating because the dollar index has been fairly high and a number of central banks have been trying to tighten. It reached a low in late 2022, which is roughly when Bitcoin reached its low. It's up off the lows, but it's still kind of in a consolidation. My estimate is that we're probably going to see a positive liquidity cycle over the next 2 years. And so while I'm less confident to forecast a Bitcoin price, I generally try to stick with forecasting probable direction or overall risk reward on a direction. And so I still incline up in Bitcoin price without trying to say what is going to be the liquid spike high that we see this cycle. I have no idea. I just think that the overall kind of momentum and fundamentals still point up for this cycle.
Alden also discusses the concept of fiscal dominance, where fiscal policy, government spending, and deficits significantly influences economic conditions and markets. She points out that despite high interest rates and measures of real rates being elevated, gold and Bitcoin have been performing well. This performance suggests that investors are increasingly aware of fiscal issues and are seeking refuge in real assets. Alden notes a significant divergence in the performance of various asset classes. Typically, during periods of economic weakness, as indicated by falling PMI, bonds perform well. However, in recent years, bond prices have fallen and yields have risen even as economic activity weakened. This anomaly is attributed to large fiscal deficits and persistent inflation, which are unusual for such economic cycles.
The rise in gold, even despite the fact that rates are this high, including official measures of real rates being this high, has been kind of very powerful. I think it's been the biggest dislocations in recent years, and that's indicative of fiscal problems. I think that supports the fiscal dominance narrative. For most investors, if you show them the PMI chart that I mentioned before, that's basically like a sine wave of cyclical economic activity. And normally when that's going down, bonds are doing quite well, meaning that their yields are falling and their prices are going up. So generally, if you just over the past 40 years always bought bonds when PMIs were falling and always bought stocks when PMIs were rising, that would not be a terrible investment strategy. And yet what we saw over the past couple of years was as the PMI fell, bond yields went up, meaning bond prices sold off. Bonds acted very differently to how they normally act in a kind of when the cyclical side of the economy is weakening. And I think that's largely because of how much issuance has been coming to market, meaning how large those fiscal deficits are and how sticky inflation is, partially because of those fiscal deficits. And gold has been kind of sniffing that out, or the gold market, because normally when you get that sharp burst higher in yields, you would normally expect more gold weakness. But I think the market's seeing through that the federal government's kind of in a fiscal tailspin, meaning they don't have a lot of levers they can pull to get overall interest expense down and to get their budget deficit kind of more under control. And so I think that some of these real assets are holding up better than we'd expect based on the things they normally correlate with, because they're forward looking enough to see kind of how trapped some of those markets are. So stocks up, Bitcoin up, gold up, despite fairly high bond yields, is kind of indicative of investors not really wanting to be in the bond market and kind of going into a variety of other asset classes. I do have concerns around some of the equity valuations because, for example, there's been a strong what investors perceive as a flight to safety. So, for example, Costco is an incredible performing company. They grow like clockwork, very smooth, very high performing compared to their category, but investors are paying like 50 times earnings for Costco. And it doesn't really have the growth to normally justify that type of valuation that's way higher than it normally has as a valuation. So it's like investors looking around and saying, I'll buy Costco at almost any price, rather than what I'm seeing in the bond market, rather than what I'm seeing in the cyclical market. And I think that's overdone. So I think the areas that are still kind of interesting from an investor perspective are ones that are not overvalued and haven't really gained a lot of that monetary premium yet. So, for example, the energy sector, I think, is still very cheap. Some of the other cyclicals, I think, are still very cheap, whereas some of those more kind of low volatility growth stocks, I think, are kind of overdone. If I were to guess, I would say gold and Bitcoin, I still think, have quite a bit to run over the next 2 years. But of course, every asset class is any sort of time frame estimate is mostly probabilistic, because you're trying to account what other investors are going to do with their money. In the 2020s, we'll have higher highs and higher lows of inflation than we had in the 2010s and say the 2000s and the 1990s, for example. We've already obviously seen much higher high than we've seen since the 70s. Right now, we're kind of testing the bottom of that range. Inflation officially is around 3%. It's relatively sticky at that level, the way that they measure it, which, that overall kind of the quality of the measurement is a whole nother discussion. But the way they measure it, it's getting fairly sticky around that 3% level, partially because energy inflation is somewhat reaccelerating from these levels. So yes, my base case is that 2%, while they might be able to touch it from time to time, it's going to be hard to make that the symmetric range that they're aiming for, given the fiscal backdrop they're dealing with. Now, if you get massive energy supplies coming online, or AI is super deflationary, they might be able to offset some of the fiscal driven inflation that we're seeing. So you could have wider than normal gaps between different areas of inflation, for example. Kind of like in the past few decades, you had a very wide gap between services inflation and goods inflation. So cheap goods coming out of China, for example, or electronics getting exponentially better per unit cost. Those things were rather disinflationary, whereas things like hospital services or anything that requires a lot of domestic human labor, childcare services, for example, these things were going up at a much faster rate of inflation. And so I think you could see a rotation in some of those categories this decade, but my overall view would be yes, higher average inflation, still cyclical inflation, but higher average inflation this decade, largely because of this fiscal backdrop.
For investors, Alden suggests focusing on asset classes that have not yet gained significant monetary premiums and are undervalued. She highlights the energy sector and certain cyclicals as attractive investment opportunities due to their relatively low valuations. In contrast, she cautions against overvalued sectors like low volatility growth stocks, which have seen inflated prices due to perceived safety. Alden predicts that the 2020s will experience higher highs and higher lows of inflation compared to previous decades. Although current inflation rates are around 3%, they are expected to remain sticky due to various structural factors, including energy prices and fiscal policies. While technological advancements and increased energy supplies could mitigate some inflationary pressures, the overall trend is likely to be higher average inflation this decade. Please like and subscribe my channel.